Australians openly embrace economic self-destruction. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
Good to see you back in the studio again after a few days away. We've had the budget, of course, and we're going to talk about that tonight.
What happened last week? So we're recording on Sunday. So last Tuesday, when the budget was handed down, it was a suicide note. And the reality is that Australians are openly allowing Parliament to bury the country in enormous amounts of debt. And we are basically going down a direction that we can never return. One of the important points that really captured my mind during the week, before we get into some of the detail of the budget, is that Michael Yander from the ABC, he put out a tweet, and let's put that tweet up on the screen. He basically said that when the ABC published stories about the budget, stories about individual budget measures which would impact individual voters, they got a lot of online traffic. Any article about the big picture, people are not interested. Well, the big picture matters, and that's what we're going to talk about today, because the big picture is extremely ugly, and a lot of Australians have a complete misconception about what the big picture is, because I think it's all about COVID-19. But once you actually go through the actual numbers of the budget, it has nothing to do with COVID-19, and it has everything to do with what I would argue protecting vested interests, i.e. the banks and the household debt bubble, as well as political management, a whole host of constituencies that have to be massaged in the lead up to the next federal election.
Well, I have to say, John, that my reaction is a bit like yours, which is that nobody really wants to think about that big picture. Everybody wants to dive down into little bits of spending here and there, and maybe that's because people can see that more clearly. But the big picture stuff is really, really critical, right? Because essentially the future of Australia has just effectively been smashed by what's happened, right? And yet people don't seem to be reacting to it.
Yes. We did a show, I think, last October after last year's budget was handed down, because it wasn't handed down in May. It was handed down in October because of COVID-19. And the amount of debt that we were racking up in that budget, we did a show, said Goodbye Australia, 1788 to 2020. This budget digs the hole even deeper compared to what we did, or the show that we did in terms of last year. Now, before we get into some of the specifics of the budget, the key point that people need to understand is, what is the economic philosophy of this budget? It's modern monetary theory. And we've done several shows on this. Some of our audience thinks that MMT is a good thing. I don't think it's a good thing. We did a show back in 2018 called The Matters of Monetary Theory, and we explained what that theory is all about. Now, the key essence of MMT is that you're using the budget fiscal policy to target a predetermined level of unemployment. And that is precisely what this budget sets out to do. So let's put slide 2 on the screen. So this is coming from the government's own budget overview website. More people are in work than ever before, and unemployment is on course to settle below 5% for just the second time in almost 50 years. Now, we have an article from the Financial Review, so let's actually put that on the screen. This article by John Keogh at the AFR, which was about a week before the budget, says that the Reserve Bank of Australia, supported by the Treasury, basically wanted the budget to push unemployment to below 5%. So that is what that is the objective of the budget, to spend as much money as possible to get unemployment below 5%. And as we just said in the previous quote, the budget says that they're going to do this for the second time in almost 50 years. Well, when was the last time that happened? That happened under the Howard government, when unemployment in 2007 got down to 3.9%. Now, if you think about how do you get unemployment low from a supply side of the economy, it's about sort of making the economy more productive. And if you make the economy more productive, businesses can employ more people. During the Howard government, there was a lot of reform, structural reform, microeconomic reform. There was things around tax. There was things around industrial relations. There was things around ports, infrastructure, etc. That actually expanded the supply side of the economy. That actually made it more attractive to employ more people, and that is what drove unemployment down to 3.9%. In this time around, there is no structural reform. There is nothing to do with industrial relations. And I should say, while it is going to be very highly controversial with some elements of our audience, work choices was a critical factor to driving unemployment down to 3.9% prior to the 2007 election. So we have no structural reform around deregulation, around industrial relations, around making the economy more productive. And I've had some economists in the last week say, where is the national productivity agenda? Well, there is no national productivity agenda. So if there's no structural reform, how do you drive unemployment below 5%? You have to spend like a drunken sailor, and you have to finance that either through borrowing from the private sector, or you've got to rely on your central bank to print money infinitum, so that you can finance these ever large deficits to get to 5%. Now, come what may, the political test now for the budget is unemployment less than 5%, and if it doesn't do so, that's going to be a failure for the government. So if we go forward and they struggle to get to 5%, dare I say that all they're going to do is just ramp up spending to even higher levels than what they've outlined in last week's budget.
And there's a couple of interesting points there, John. The first is that that level of unemployment is based on a certain measure of unemployment. It's the official measure, which basically means working an hour a week. And so my expectation is that many of the jobs which will be created, and there will some be which will be created, will be low-paying, not very attractive jobs in some ways. There will be a significant growth in service jobs, particularly aged care and healthcare, for example, where, of course, there's been a lot of growth. The question I've got is, you can grow the jobs and you can drive the unemployment down, but that doesn't actually create more momentum in the economy. It doesn't actually create more value in the economy. So whilst unemployment might be an interesting measure, it's not really a very good measure of anything really relevant to the future momentum in the economy, is it?
Look, so you make an excellent point, Martin. So if driving it, so what generates wealth? It's about creating value. So that should be the focus of economic policy. So if we look at last year's budget, last October, for June 2024, what was the gross debt, and how does that gross debt number change based on the numbers from last week? By June 2024, gross debt will be lower by only $4 billion. Yep. So even though there's all this big news about things are going much better than expected, that we're going to have a much smaller deficit this financial year than what we thought, because they have racked up a massive amount of spending going forward, gross debt is only going to be lower by $4 billion. So the debt burden, it really hasn't changed in terms of what we're going to expect by June 2024, and that was the sort of that was sort of the rough number that we were talking about last time. And again, June 2024, the budget is forecasting gross debt for the federal government to be north of $1.1 trillion, right. With no plan for a surplus and no plan to ever pay this debt back.
Remember, that's just the federal budget. We've also got all the state stuff too, right?
That's right.
Because we'd already previously calculated that net had been spent across the states and feds at more than $1 trillion.
Yes.
So the total debt burden for Australia is a lot higher than the 1.1 trillion that they're now talking about.
Correct. Now, what is the key vulnerability? It is interest rates.
Yep.
So a couple of points. It is very interesting that over 6 financial years, the budget is assuming from July 2019 to June 2025, the federal government will spend $113 billion on interest. Now, when you have a government with no debt, like we did in 2007 under John Howard, you don't have to pay money on interest, and then that money can be invested in all sorts of worthy causes throughout the country. But we're now going to be wasting 113 billion over 6 years, and again, that number wasn't presented to the public, and people don't understand that as this debt continues to grow, by financial year 23-24, the interest bill is roughly going to be about $20 billion a year. That is, by historical standards for Australia, that is a staggering amount of interest that we have to pay. And just think of what we could have done if we actually ran a tight ship and we didn't have so much debt and we didn't have to pay so much interest.
No, absolutely, John. And it's a frightening amount of money at low rates. But of course, the forward yield curve is indicating significantly higher rates ahead.
Aha. Well, so the interest rate is a very interesting thing. So let's put up the next slide, because the next slide basically assumes that in fiscal year 1920, the government paid an effective annual interest rate of about 2.45%. They're expecting that from July 2022 and beyond, the interest rate is roughly going to be 1.8%. Now, that is a historically low number. If that number does not hold, and here's where governments typically get into trouble. If that number doesn't hold, what does that mean? It means that the interest cost, so we said roughly 20 billion a year. If these interest rates were to double or triple, which is not out of the realm given the historical rate of interest that the government has had to pay, the interest cost could balloon to 40 billion, 60 billion dollars, and then that's when the rating agencies are going to say, we don't think you're good for the money. You're going to lose the AAA credit rating, and also things can unravel very quickly. So these effective annual interest rates are basically a very dangerous set of arrangements that the government has assumed, because, dare I say, I think the interest costs, even though we said over 6 financial years it's going to be 113 billion on interest costs, I think that number is going to be much higher, because they have basically assumed very unrealistic low interest rates over the next few years ahead.
I expect the only point to make there, John, is that all central banks in the Western economies have the same problem. And so the combined worry about the impact of rising rates will force those central banks to try and keep rates as low as they possibly can for as long as they possibly can, right? So they'll be trying to fight the market, because the market's already saying rates are going to go higher, the risks look like that. So that's going to put a lot of contention on the financial system and on the financial markets over this period. And interestingly, of course, there is an argument to say, well, if you allow inflation to go high, then in real terms the debt gets squeezed in terms of its relative value to the future, right? So on one hand, they want to keep interest rates really low because of the interest rate costs. On the other hand, they quite like inflation to come in and reduce the real exposure of the debt into the future. Kind of both.
So we've established there is no plan to pay back the debt.
Yep.
But in order for government finances to remain intact, they have to at least pay the interest. Because if they don't pay the interest, well, then the whole thing will come crashing down. So how are they going to pay the interest? Now, I found this really interesting quote from John Keogh at the AFR. So let's actually put this on the screen, because this crystallizes a lot of stuff. Freidenberg's argument is that with interest rates historically low, economic growth will generate enough tax revenue to cover the cost of servicing interest payments over the next decade.
Interest payments? That's an interest-only loan then.
Exactly. So what they're effectively saying here is that we're going to generate income to just pay the interest. That is the quintessential interest-only loan.
Yep.
Now, in this case, it's a variable interest-only loan. It is not fixed. But again, if anyone thinks that there's going to be a plan to pay back the debt, there is no appetite in the RBA, in the Treasury, in Parliament to pay back the debt. The debt is only going to pile up, and our children and grandchildren are basically stuffed. And the only way this game of musical chairs continue is if they can continue to serve this interest-only loan. And we've obviously seen in the mortgage context that there's been a number of people with interest-only loans who get caught out because their circumstances change and they don't have enough contingency to adjust for those circumstances. That's what this government has set this country up for.
Right, and just recall, before COVID, right, RBA and APRA, through the Council of Financial Regulators, pushed down on interest-only lending for mortgages because of the enhanced risks of financial instability caused by them. And yet now we're following precisely the same recipe with massive amounts of debt, just worrying about servicing the interest and not worrying about repaying the debt.
Thing is, look, what can we say for a bunch of hypocrites? Interest-only loans are too risky for households to do, but why don't we put the government on an interest-only loan? And my responsibility to my children is to ensure that the country that I was given as a young adult, I'm going to give them a better situation when they become adults. And my daughter's 6, so we've got 12 years until she turns 18, and we are on track for her to have to be honest, a terrible adulthood because of the decisions that Frydenberg has made, both last budget and this budget.
Yeah, John, and I want to make just one other point, which is the amount of money that's being invested, right, is not actually going to give us any long-term legacy in terms of future value, right? There is an argument that you could have invested a large amount of money on changing the nature of our economy for the good into the future. But none of that is in this budget. So it's a big number, it's a risky number, but it's not actually delivering long-term value to Australia either. And that's another negative to this whole budget in my view.